All right, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, May the 8th, 2025, just recording this about 7:30 in the morning. Okay, so let's look at the overnight action. Basically, probably the most important thing in a certain sense, apart from the Fed, there was an announcement, or there's going to be an announcement at 10 o'clock this morning from Trump, a big trade deal with a respected country, as he likes to call it. But basically, that's leaked, and it seems like the trade deal is going to be with the United Kingdom, with the UK. Now, just keeping in mind that we don't have the exact details, but what seems to be part of the deal is going to be sort of reduced tariffs on cars being made in the UK being imported into the US. And in exchange for that, the UK will apparently be buying sort of more agricultural products and things from the US. So, the market is taking this as a very positive sort of reaction. So if we just start looking at stuff, there is quite a lot of risk, a bit of a sort of a gentle risk on kind of tone here. You can see the VIX, the volatility down. You can see the stocks are quite liking that. So the stocks had a nice comeback after being battered a little bit by Jerome Powell. We'll get onto the FOMC later. So you see here the stocks at pretty interesting sort of levels here from a technical perspective. This is the ES, the front contract. You can see here we're getting up towards sort of recent highs. Now we're definitely getting up in towards that level, breaking out of the box of the Trump tariff announcement, which is over here. Again, I do believe it's going to be difficult for this market to go substantially higher than, let's say, about 58.75, something like that, or let's actually more exactly, yeah, something like about 58.35 to 58.75 in that zone there. And why is that? But again, this depends. This is going to be very, very interesting because the market is often like a 12-year-old boy in the sense that it sort of acts first and sort of thinks and thinks later. And it's going to be very fascinating to see what happens if the market looks at, for example, this trade deal with the UK and says, oh my God, this is amazing news. Or does the market step back a little bit and say, well, hold on. At the end of the day, we're still getting 10% tariffs on UK goods being imported into the US, which is much more than historically we've had. So it's got to be a fascinating tug of war here, sort of a tension between short-term euphoria and sort of relief rally that the tariffs are not as high as expected. But then I just wonder, sort of medium term, does the market pull back a little bit and say, well, hold on, having these sort of elevated tariffs are much, much higher than we've had, certainly since, in the last 20 or 30 years, and going back to levels we haven't seen until, the 1930s after the Great Depression. So it's got to be fascinating here, as I say, to look at this reaction. We also have, we're going into the weekend at a certain point, another couple of days or so, and we have the famous meeting in Geneva between Treasury Secretary Bessent and the Chinese Vice Premier. I mean, that seems to be a meeting, much more based on sort of protocol and setting an agenda rather than substantive talks. And again, it's going to be interesting just to see how the market takes that as sort of a lack of progress, or that's going to be enough just to set an agenda and a couple of positive sound bites. So all that to say that we do have a risk on this morning, and is there a danger or like a risk in sort of technical terms that the equities and risk on it comes to the front? Absolutely. I mean, it's very possible that the stocks push out here and go a lot higher. Another thing, just while we're talking about the stock market here, obviously something like NASDAQ also enjoying that. And you can see NASDAQ here at a pretty critical level as well. There's the sort of the Trump announcement here. So NASDAQ a little bit stronger. And that makes sense because there was also some quite positive news yesterday in terms of especially a company like NVIDIA, because Trump, I mean, again, the devil is in the details. But the headline, which got the market's attention, was that the Biden era, remember in the last week of Joe Biden's presidency, he put a lot of controls, export controls on the most sophisticated AI chips going to places like China, basically saying, no, the most sophisticated AI chips cannot be exported over to China. And of course, this was a negative for companies like NVIDIA, whereas Trump seems to have rescinded that order. Now, there are going to still be some restrictions. It's quite complex. Yesterday, I was reading a bit more of the details. It's not a universal lifting of that ban. It's a much more nuanced kind of situation. But the reality is there is, some sort of, how can I say, expansion of the export possibilities for companies like NVIDIA. And therefore, if the NASDAQ can punch above this 20,250 level here, for sure, that could go and retest a bit higher at 20,500 or even higher. So there is some upside risk there. In terms of other reaction to this sort of news, we can see here also over in Europe, European equities also pushing higher. We see German equities, the DAX also now at highs, pushing higher. So it looks as though we're about to get another push. If we look over the Nikkei, we can see not as strong as reaction, but certainly following sort of global equity. So things like the Nikkei and the Topix, also everything moving together in a very highly correlated way in terms of the stock indices globally. Okay, we also just now had the Bank of England cutting. That was expected. There were a couple of members on the nine-person board. Actually, two members wanted to cut more dramatically by 50 basis points, and two didn't want to cut. So that was nothing particularly sort of unexpected. Then, if we look at the reaction of the gilts here, actually down a little bit. This is a daily chart here. This is the 10-year gilt, down a little bit. No huge reaction there. That was more or less as expected. What is interesting, just to look at also just this risk on, if you look at the bonds here, you can see that the US bond, this is the 30-year bond, down a little bit. We do have a 30-year auction at 1 p.m. Now, we've had already in this week the 3-year and the 10-year auction. Both of those went quite well. The 10-year went pretty well on Tuesday. So today, though, to close it out, we do have the 30-year. And as if you follow the news, you'll know there's been a lot of talk about, possibly like Taiwanese life insurers offloading some of their long-term treasuries. So, as always, let's keep an eye on the 30-year auction just to see if there's plenty of institutional and central bank demand for that. But there's no reason to not think that. On the other hand, if we look at the short end, which we'll get into in a second, we see the short end here, the ZT, the 2-year has gone down a lot more than the long end, and this is just probably based on what the Fed had to say yesterday, which, as I say, we'll look at in a moment. Just in terms of this risk on. In terms of, let's just have a look at the dollar. You see the dollar, interesting here, the dollar index starting to push a little bit higher. Again, what's interesting to me is that with the risk-on attitude and sort of a Fed which seems to be in no hurry, the dollar is not finding it easy to have powerful moves. So we have seen a little bit of a green candle here, but we're not seeing these sort of very powerful moves. You look on the downside, the red candles seem to have a lot more energy than the green candles, and even something like this one here back on the 22nd of April, pretty quickly faded, and not really a sort of a strong move. Now, that's not to say that the US dollar is not having a little bit of success, shall we say, on the back of this risk-on move. You look here against the Canadian dollars coming off the key support level at about 138, 138 and a half. We can see also the Aussie dollar here, just falling back a little bit against the US. We can see against the Japanese yen, the US dollar going up. And just finally, let's have a quick look at the euro. See the euro coming down a little bit. So the US dollar, having a bit of support here, that's putting a little bit of pressure on gold. If we look here at the gold futures, you see gold coming down. Now, again, gold has been bought on every dip, and it's a little too quick just to say, oh, this is a sort of a failed double top, and it's coming all the way down. It's possible, but we still have a lot of retail interest in China. We still have a lot of central bank interest, especially in China. So a lot of Chinese sort of central banks are buying. On the other hand, we're getting a slightly sort of US dollar, which is rebounding a little bit. And we're also seeing that the speculators, if you look at something like the Commitment of Traders report, a lot of the hedge funds and these kind of players are actually short gold at this point, or they're certainly not buying. So I don't know. I mean, it also could be possible just like a bit of a sideways consolidation for a moment. If we look at silver, similar kind of situation here, just the slightly stronger US dollar. Although it is interesting because with the risk on tone, ordinarily silver, in theory, should be relatively happy with that and possibly even outperforming gold. So silver's not having a bid. And the other thing which is kind of concerning in a certain sense is also copper not really ripping. So the point is that this the trade deal with the UK and the meeting in Geneva between the Chinese and the Americans, okay, it's positive, but you can see that, let's say, from the copper market here, and something like gold, and something like the US dollar, still not huge moves. Even in the equities, we're up about 1% today or so. Let's just have a quick look. I think we're up about, since the futures open, about 1%. So not explosive moves. There's still a lot of nerves. there's still a lot of skepticism, and the devil will be in the detail, you know. And as I say, I repeat that even though some of these sort of so-called trade deals are less worse than expected, net net, if you go back 3 months, there are still more tariffs happening. That's the key thing to keep in mind. Also, just getting a little bit of a bounce today on a slightly softer US dollar and a bit of a more of a risk on a positive tone. You see oil here again, not very powerful moves on. It was rejected yesterday at a pretty key level around about $60.20 on the front contract of WTI. You know, the curve is still, you know, in a backwardated sort of shape, so still signaling a bit of a physical sort of tightness. We also had yesterday the Department of Energy numbers in the US, and they were quite supportive. We had sort of draws in gasoline and crude oil. So that was quite supportive in theory. And we also have the sort of the heating season coming up in places like the Middle East. And we also have the driving season coming up in the US where, you know, which ordinarily guzzle, they cause, you know, a lot of gasoline at least. So, you know, who knows? Maybe it's just going to be a sideways consolidation, you know, and try and test a little bit higher. But at this point, you know, not a huge amount of energy. And keep in mind as well that Trump is heading off to a trip to the Middle East. When is that? I think it's next weekend, not this weekend, but in a week's time. So there could be some, you know, announcements there. But again, that's a little bit into the future. Just in terms of other stuff. So if we go back to the Fed, yes, I'll just grab some tea. So what did the Fed say? So Powell, a lot of commentators were expecting Powell to be neutral with a slightly dovish tinge or tilt, sort of acknowledging the fact that, you know, the situation was precarious, maybe towards the downside. What Powell did say and what we had in the statement, the Fed pointed to much higher risks of unemployment going much higher. So, you know, the economic conditions are worsening substantially and the labor market worsening substantially. But that was offset by increased risk of higher inflation. So essentially the Fed it's almost like the dispersion of possible outcomes was widened a little bit to say, well, you know, there could be a lot higher inflation. There is the possibility of the labor market collapsing a little bit as well. So if we put that together, we can use a simple word and call that stagflation. So heightened risk here of stagflation. Obviously, Trump has just come out this morning calling, what did he call his head of the chair, a fool. He's now a fool. He's a too late fool. But as Trump just posted, he says, but I like him a lot apart from all that, although apparently Powell has no clue. Now, what did Powell say? He essentially said to the market that they have a high degree of uncertainty. As I just said, that you know, their two mandates, they have heightened risks and uncertainty about that. And essentially he said he was going to be data dependent. He will need to see the hard data. He was peppered in the press conference with a lot of questions about the difference between what the soft data is saying, and the soft surveys seem to be saying that, you know, the economy is weakening. There are signs of that. But Powell basically said that, you know, in the past there've been you know, sort of false signals from the survey data, and he personally on the FOMC, which was unanimous, is waiting for hard data. Now, what that means is that we could have to wait, you know, sort of a month or two or three. And Powell was very clear to say that the real economy at the moment, in terms of the hard data, was solid. He said it, the real economy is solid. And he said many times that he personally does not see signs of weakness. He did not rule out the possibility for weakening in the future. Now, in the same way, he characterized the labor market also as very strong. But again, he said that it's possible that might weaken in the future. The other thing which I thought was also interesting and a key point was that he mentioned inflation. And he sort of gave the sense that inflation could worsen, but at the moment it was pretty good and pretty stable. And he, you know, we pointed to the fact that, you know, oil prices were a bit lower, services prices were sort of down, housing prices. So it's interesting that absent the Trump drama and the tariffs, I think the Fed would be cutting, because he basically was saying that, you know, the employment situation is in a good place and inflation is getting down towards their target, is in a good place. So it's almost as though he's not cutting because it's like a fear of what potentially could happen. So if those fears do not materialize, in terms of stickier inflation, you know, who knows, maybe we could get a cut. But he also said at one point, something a little bit vague, but essentially say, hey, it could take a year before we get enough data. Interesting. So what does that what does that all of that mean? I think the bottom line here is to say that we have a Fed which is extremely data dependent, data really focused on the hard data, the real data, not just surveys and sort of indicators and whatnot. So hard data, and I think he's in absolutely no hurry to cut. So if we look at that, that's reflected just in some of the sort of the metrics we're seeing here. Let's have a quick look here. So yeah, so just looking at sort of what's priced in. So now what we can see is that the one I like to look at is the end of the year. So December, you can see that that was at four cuts about sort of 10 days ago. It's now down to 2.9 cuts. So let's call it three. If you remember yesterday, it was over three, about 3.1 or so. So that's been priced a little more sort of hawkishly essentially. And if we actually go and just look at a few things here, we can see that, for example, the December, you can see here that the market initially, this is a tick charts are very short term. You can see that initially the market priced in a little bit more sort of dovish. Maybe that was on the headlines from the statement at 2 o'clock saying there was increased risk of the unemployment situation worsening. But once the market sort of digested his press conference and sort of thought about it, as you guys can see here, we've gone from about 78, 79 basis points of cuts by December down to about 74. So a full sort of 5 basis points of hawkishness. Sort of priced into the market, so less active cutting. And I think really what's going on here, if we just look at a couple of charts quickly here, you can see here this is on the Fed Fund futures, so not the SOFR, but the Fed Fund futures. So each dot represents 1 month, and we can see here the price action. Well, the implied yield. This is actually the implied yield compared now, which is the white line is live data and the blue. So we can see here that overall. The market, as I just said, has repriced slightly hawkishly, so the implied yields have gone up a little bit. But you can see not so much at the front of at the front of the curve. Most of the action has been towards the end of the year, but really the main, has been next year, so about 3 or 4. So that's kind of interesting here. And what also I'm looking at here is just this whole idea of pushing the cuts out, so pushing the cuts out in time. That seems to be the market narrative. So what I'd like to look at again is the spread between December 25 and December 26 here on the 3-month SOFR contracts. And what you can see here, this is the implied yield. You can see that the December 25 sort of yield actually has come down, on this graphic by 12.7%, whereas the December 26 has come down by about 19% in yield, implied yield. So what that is basically telling us is that there's a difference here in the market. You can see here the spread here now up to 44 basis points. Essentially, what the market is saying is that we're going to get less cuts in this sort of short-term period, and those cuts will be pushed out longer, maybe sometime late 25 or even into 2026. And that's why this spread here is telling us. And basically, the market's been thinking that since February, March, April, you can see it was almost that they were almost the same at zero. And in fact, when it was red here, you can see that the market was actually pricing in a much earlier cut. So you see here sort of beginning of the year. But as the increasing fears of tariffs have come in and inflation fears and inflation has remained sticky, the market is more comfortable pushing out these cuts from sort of something like, anchored around, let's say, the end of 2025 until the end of 2026, just from a mathematical perspective. So this is a spread which I'm watching with a great deal of interest here. Now, of course, this could come the other way and flip the other way if suddenly the unemployment rate significantly rises, the labor market deteriorates, the real economy deteriorates, and maybe if we get trade deals and some of these tariffs come in and generally things start sort of moving again. Who knows? This spread could actually flip. So that's something I'm looking at. Okay, guys, just finally, I think I've spoken too long here, so I'm going to get off in a second. Just today, talking about some information. We do have the initial jobless claims coming in about an hour or so. So let's have a look. Now, you'll remember that last time they were 241,000. So they are creeping up a little bit. Still very solid, still, indicating a very robust kind of labor market, but they are creeping up slowly. And we do have the survey for 230,000, which again is starting to creep up. What is interesting is the continuing claims. Again, That's starting to creep up. So let's keep an eye on those. And of course, the one the Fed likes to look at is the 4-week moving average here, which is at 226,000. So let's see if there's any sign of the labor market, continuing to sort of weaken at all. Other thing which we'll be looking at this morning is the unit labor cost. Now, this is a quarterly number. The Fed definitely looks at this. This is the preliminary number. And again, you see the prior was 2.2. That's expected to have rocketed up to 5.1, which is higher. The Fed will not like that. That is inflationary, of course. So let's look at these two things this morning and see what's going on. And the other thing as well, as I say, Trump apparently is having a press conference to announce this sort of trade deal with most probably the United Kingdom at 10 o'clock. Apart from the details, it will be interesting just to see how the various markets react. Are the markets going to take this as a fabulous bit of positivity, or will the markets do this as a little bit of, sort of buy the rumor, sell the news? And once the markets actually dig into the details and understand that actually this does represent a sort of a lower tariff than Trump had trumpeted, but no pun intended, but a sort of a more permanent tariff, which perhaps is not great news. So it's going to be very sort of fascinating just to see the market reaction at 10 o'clock to that. Okay, I'll leave it there. Have a great day, and we will continue the conversation. Thank you. Goodbye.